right now, everyone is panicking in the stock market. So people are either screaming, sell everything right now, the crash is coming, the crash is coming, or they're telling you to change the way you invest by throwing more money in now, because that's the way that wealthy people invest, and that's how wealthy people make money. I'm here to tell you that both of those solutions are wrong and that market timing is a losing game. And I want you to be a more intelligent investor, and I'm going to show you how to do that in this video. So let me walk you through the first example of why market timing is not the right move. So this was a great post 6 years ago that I saved that I want to highlight. You have Tiffany, Brittany, and Sarah, and they each want to invest during their life, but they each have really different emotional makeups. So these three people, they make different investing decisions in their life. Tiffany, she saves $200 a month, but she decides to only invest at the worst times. So a person like this, what happens is they are scared of investing, but then the news and everything around them is telling them buy, buy, buy. It's a great time to buy. You need to dump all your money in, and they start wanting to chase results in the stock market. And so typically what happens is these types of people, they put their money in at the exact height of the market before it comes crashing down. Every peak, she's putting in all of her money, and then it crashes, and then she's scared of putting money in, so she saves it in her bank account until it's up again. And then when it's up again, she puts it all in, and then it crashes again. And so that's the first type of person. Second person, Brittany, this is the other group that says, you know what, you need to save all of your money until the market crashes, and then put all your money in, and you can buy when everybody else is running away. Okay, so let's say Brittany, she knows the future. She knows exactly when to put this money in, when exactly at the bottom of the market, and then she dumps all of her money in and watches it grow. Then the third person, Sarah, she doesn't really care. She just says, I'm going to invest $200 a month, and whether the stock market's going up or it's going down, I'm just going to invest this money. So the question is, if we look back over the last 40 years in the stock market, in the US stock market, what has happened to these three investors? So they each invest $96,000, but they just do it in different ways. Sarah just does it automatically. She doesn't listen to any of the news. She doesn't listen to any of the fear going on. And she also doesn't get really greedy and decide, hey, I'm gonna wait until the perfect moment. So what happens? So here you can see the difference in performance for these types of investors. So Tiffany in blue, this is great news for people like Tiffany. So if you get easily scared and you feel really confident when everyone else is excited and you dump your money in and then the market crashes, the great news is that even Tiffany was successful. So Tiffany made about $650,000. Brittany, the one that was able to time the market perfectly and put the money in when the stocks were the cheapest right before they took off again, she made almost $1 million. Now, the ironic thing is that Sarah, who decided to not pay attention to any of the news and completely ignored everything that everyone was saying and just automated her investing and invested $200 a month, no matter what was happening, she ended up winning. So she almost ended up with you can see it, $1.4 million. And so the first lesson is that you can't time the market. And then even if you could time the market, it doesn't mean that just holding your money on the sideline for this perfect moment is actually the key to success. So if someone is telling you either of these things, run away from the market or wait until it crashes, I am more in the Sarah camp of investing, where I automatically invest and I don't really care what's going on. Now, I will point out I am not your financial advisor, so you should think about this as educational. Now, I've been investing for 15 years, and this is what has made me very successful. But there's other ways of investing, and do what's best for you. Okay, so let me give you another really important point. Another way to look at this is to understand the impact that missing the best days in the market has on your portfolio. So there's a lot of fear that you need to protect your money, you need to get out of the market. But a different study looked at over the last 20 years what happens to someone's money if they miss the best days. And so, what's interesting is if you just stayed invested and you were consistent and you ignored all of the noise, you saw a nearly 11% return on your investment over the last 15 years. But what happens if you're an investor that gets scared, you take your money out, and then you don't know when to put your money back in, and you start missing the days where the market's actually returning good money, good return? What you'll see is that profits start to shrink significantly. So after missing just 10 of the best days in the market over the last 15 years, just 10 days, you've cut your return over that 15-year period by half. You're down to almost just 5%. And then if you miss 20, 30, or 40 days, you actually start dipping into negative return territory where you're not seeing a return on your investment. And so this is the difference between someone that actually builds wealth successfully with investing versus someone that really just stays poor. And you can see examples of people like this where, maybe the 2008 housing market happened and there was a crash, but then they never reinvested from 2008 to 2011 when the investments really spiked up. And you'll hear people, if you talk to them, they'll say, I lost a lot of money in the stock market in that period, and they won't invest. Well, the reason is because they got out at the worst time and they decided to not reinvest, and they missed all of those really important days. And so the key is that we have to stay consistent, and it's just as critical to not miss the best days in the market as it is where you might think that it's just as critical to try to avoid all of the bad days. The key here to take away is that nobody can predict the market. We don't know if it's going to go up or down. And anyone that is telling you with some level of specificity that it's definitely going down and you should do this, they're they're either uneducated or they're lying to you and they're trying to sell you something. So on the selling point, I like this chart and I pull this up whenever I get scared and I feel my emotions running in the market. There's always a reason to sell. So no matter what happens, the news cycle is running on fear. Their goal is to get you to click on their article, to click on their video, to get attention from you, which ironically, as a YouTuber or a new YouTuber, I'm learning attention's really important. And so there's always a temptation like, how do I get more clicks? How do I get more attention? Well, that news cycle just ramps up during periods of fear. So the news is just pumping into your brain, telling you to sell or to be scared or to drive attention. And so the interesting thing about this chart is you can see that there's always something going on in the world that is scary, that you don't know what's going to happen in the future, and is tempting you to leave. In fact, this chart ends with coronavirus. So if you were in 2020, it felt like the world was ending. Well, what happens? 3 months after the big crash in March, the stock market spiked up. So if you were scared and you were staying out and thinking that it was just going to continue to crash, you missed on the whole upside of that market. And that's how wealth is either destroyed or built. It's by staying consistent, not trying to time these different things. Because the answer is we just don't know. Now, the problem with all of this, and the part that a lot of people talking about money miss that they don't share with you, is that there is real risk. It doesn't mean, none of this means that the market is always guaranteed to just go up. So, what's happened in the United States over the last 18 years is we have been in this bull market where things just go up and up and up. And we have been trained that when things go down, they're automatically going to go back up and it's not going to go down for a long time. And so you have to understand what the risk is when you invest. And for that, I want to show you different examples around the world that have happened and will happen again and could happen in the United States that have a significant impact on people's wealth building. Okay, so the problem with a lot of investors is that there's this inherent belief of American exceptionalism. And to be honest, there's a lot of people that and have been proven right that America's exceptional. The markets and the companies and the way America fosters business is really going to sustain and be above every other country. But let me show you an example of an exceptional country, Japan, that believed that they had that same level of exceptionalism in their investing and their banking. So in the late 1980s, Japan had a massive equity bubble crash. So what you can see is that back in 1989, Japan had some of the highest equity valuations in the entire world. Their stock market was booming. There was all of this confidence around Japan as like this leader in technology and innovation, which might sound a little familiar with when we talk about AI and technology and all this stuff. But there's been this huge upswing. Well, what happened after 1989? There was this massive crash, this bubble that burst. And so if you are an investor that invested in Japan in 1989, what you can see here is that as of this chart, which goes to 2016, if you had invested at the top of this market, you have still not gotten your money back because the market has continued to underperform its highest peak. And so the truth is that in any type of equity, there can be periods, long enough periods that are like your entire life where you don't see the return that you might expect. And so while it is true that if we look back at world history, that the stock market always does go up. A consistent 6 to 7%, depending on if you're looking at worldwide stocks or the United States. We can look at this trend line, but we don't live in 200-year periods. We live in days and months and years. And if I'm going into retirement and I need this money for the next 10, 20, or 30 years, it doesn't do me any good to understand that the stocks will eventually recover and they will eventually go back up when there's periods like this in Japan where you have periods of lost decades. But then the challenge is if we understand risk, we understand that this can happen. We can lose 50% of our money that is invested in the stock market, but we can't not be invested in the stock market because then our money's just getting eaten by inflation and we can't really time the market. And if we miss the best days in the market, then what do we do? So for that, we need to talk about your ability to take risk. So if you understand that a market can crash and be down for a prolonged period of time, but let's say you're young, you're 20 years old, and you have a time horizon of 20 years or more, then being fully invested in the stock market shouldn't impact you. Now, that word should is a really strong word because that doesn't take into account your emotions and how you react to crises. So for me, I'm more of like a doomer. I actually usually think the sky is falling. I'm not an optimist. And so for me, when things are going badly, it's easy for me to emotionally react to things and believe that the worst is going to happen. And while the worst could happen, it typically doesn't. And so we have to balance our emotional makeup with the investment decisions that we make. If you need the money that you're investing, let's say in the next 5 years, well, that's not long enough if there is a significant crash for you to recover that money. And so what we want to avoid is times where you are having to draw on your investments, like you need the cash when the market is down. And so what we have to do is we have to plan around what different levers could we pull before we need that money. So let's say you're young and you have 20 years to invest and you're dumping all of your money into the stock market today. Well, what you know is that you might have a high appetite for risk because you have a long period of time. We also have to look at though, what's your expertise with your job. So the problem that a lot of people miss in these down cycles is that the stock market doesn't operate in a bubble, which is ironic. So the problem is that when the stock market crashes, what is the stock market? It's all of the US companies that are out there. So when they're losing value, what are they doing? They're firing people. They're getting rid of all of their workers. So you've seen in the last month government workers getting laid off. I think if you're a government worker in the past, you might have thought, well, my job's really secure. See, look at how quickly this situation changes where we think we're secure in our job and then we're not. So we have to think about, how secure is our work? Now, if you're a tenured professor and you know that you're not going to get fired, or maybe you're a dentist, or you have some profession that's always going to be around and you don't worry about losing your job, then it's easier to invest more and more money because you know that you're going to have this job that's providing you income. That means you're not drawing on your money. The other thing you need to think about is how liquid is your money. And what do I mean by liquid? So if you have a situation that might arise where you need a lot of money quickly, then you have to start thinking about not investing all of your money in the stock market because it might be in a moment like Japan where it's decreased significantly and now you're having to draw on money. And then lastly, what's another option that you might have so that if something happens, you have another way of making money so that you're not having to draw on these investments while they're declining. So if you could get a second job, if you could cut down on your expenses, the more limited you are on having a plan B option, the more at risk you are of these big market declines because you don't have another way to survive without taking money out. And so that all has to go into your makeup as you think about how is my money invested? Okay, so then how do you actually win in the stock market? The first is that you're being consistent. So if you have the stock market right now causing you a lot of tension and fear, and you're in and you're out, and you don't know which way to go, and your hair kind of is on fire, that's a great indicator, and hopefully something that you can learn from these last couple weeks, because who knows what's going to happen in the future? It could get worse, it could get better. We don't know. Is that you might not have the level of appetite for risk that you thought you had. And so I am not 100% US equity investor. And what that means is I don't have all of my money invested in just the US stock market because I don't know if America is exceptional. Maybe that is, maybe it isn't. Maybe it'll go the way of Japan, maybe it won't. And so I'm looking at different ways that I can diversify my investments so that I am guarded from potential downside. And I don't have the risk appetite that I did when I was in my 20s and early 30s, because now I'm early retired and I need an income. And so I'm at a different point in my life. And so my risk appetite has changed. And so, how do you manage your risk? Well, the problem that most people have is they believe that they manage risk by timing the market. And so, the way you manage risk is not by taking your money out of the market and putting it in at the exact right time. Hopefully, by now in this video, you can see that that's actually not right. So, what do we do? So, the two other major classes outside of just investing in US equities are going to be bonds, and it's going to be other stocks across the world in different parts of the world, different sectors. And so, the way I think about it is I'm balancing the level of risk that I'm taking when I'm exposed to the US stock market. I don't know what's going to happen. I do know that over the last 100 years, the US stock market has outperformed any other part of the world. Will it continue to do that? I don't know. But I need to be exposed to the US stock market because it is a significant market. But for me, I like to know that I'm diversified in different areas. I accept the level of risk that I have for the money in the market, and I just stay consistent with the amount of money I have invested. I'm not trying to time the market. Instead, what I do is I de risk parts of my portfolio by investing in things like bonds or other parts of the world. So, what I've done here is I'm showing you different portfolios that you could use to account for different levels of risk. The key here is that you need to understand the different trade offs, because if you take less risk, you're going to make less money. What we're trying to balance is finding the right level of risk for you and your unique situation. And again, I am not your financial advisor. So, again, take this as just general information that you can help inform you about how to make a better decision with your money. So, in this example, I have a portfolio where it's a 60% stock mix of US stocks and 40% US bonds. So, then the second portfolio is maybe taking the argument that maybe the US stock market is not exceptional into the future. And so, what this looks at is, what if I take some of my US stocks and I invest instead into every other part of the world, because I don't really know what part of the world's going to do well. I don't know what part of the world's going to do poorly. And I don't know if the US is going to continue to be above the others for the rest of time. So I'll take a little money and I'll put it into international stocks. And then I'll still keep my bonds so that I have that extra security that's a more stable income should I need it. And hopefully that it's taking on less risk than I'll see in my stocks. Then the last option I just built for fun is, what if you just did a total world investment? So, what this would mean is, instead of investing solely in the United States or another part of the world, what if I just spread my money across the entire world and I just let it ride? So, this goes back to 1986. If I were to invest $10,000 back in 1986, where would I be as of February 28th, 2025? So here's the really interesting thing. So if you were to just invest in the US stock market or the top 500 US stocks, which is called the S&P 500, you would clearly have the most money out of any of these portfolios. So you would have over $500,000 from your $10,000 investment. Now, let's go back to our example where we took 40% of our money and we put it into bonds. They're not going to earn as much, but they're safer. But if you look at your total balance that you end with after this time period, you've almost cut your earnings in half. So you have $250,000 versus $500,000. Same thing with our second portfolio, where instead of investing in the US stock market and US bonds, we add a little bit of international exposure. Well, this actually does worst of all three of them, where you end up with only $182,000. Lastly, if we just invest in the total world stock market, you end up at about the same place as you would if you were a 60% stock, 40% bond mix. Now, it's really easy, and this is what people sell you on, is just put all your money into the S&P 500 or the stock market. It's always going to go up over time and you'll be good. So, I'm not arguing that that's happened in the past. We don't know if that will happen into the future. Now, there's a 100-year history that has shown that it has, but past returns do not indicate future success. We do not know. And so, if you're okay with accepting that, you're okay with being 100% in the US stock market, knowing that there could be a 10, 20, 30-year crash where maybe we're at the top right now and we don't see this peak again for another decade. That's okay. Then just go with that. Then you just have to accept that that's the risk and you have to be consistent with your investing. If you're at a different place in your life where you need a certain level of income, maybe your job's not as stable, and you're worried that if there's a crash, you're going to need to take money, then you might consider being in one of these other mixes. You might consider having a bond mix. Because when we look at the maximum drawdown, which was the worst crash that happened, this stock bond mix, it went down 30% from 2007 to 2009. If we look at the Vanguard 500, it's 50%. And so imagine we're talking right now about, we're down 6% so far. Now imagine that that's almost 10 times worse. If you're freaking out right now about a 6% drop and you're uncertain about the future and it's causing you to question how you invest, could you imagine what would happen if we had a 2008 moment where if half of your earnings were just wiped out overnight, or at least over about a year? If that really impacts you, you have to take into account that then maybe your risk appetite is not right. So here's what you should do right now. You should use this opportunity to assess your risk tolerance. And if you find yourself not sleeping or really stressed out because a certain stock's losing a lot of money or you don't know what's going to happen in the future, it's all pointing to the fact that you may not have the right risk allocation. And so the way you can fix that is by investing in more secure assets that don't earn as much money over time, but help you sleep at night. And so that's what we have to balance. And if you push back on that idea and you say, well, no, I want to be invested 100% in the stock market because that's the number that always goes the highest, then just accept the fact that you're exposing yourself to a lot of volatility. You could lose half of your money at any given moment, and you could be down over a long period before it recovers. If you can accept that, and then you can stay consistent, like in the examples that I showed you, where you're investing 200 bucks a month, no matter what's happening, then you will be successful. So that's the goal, is that we're not trying to switch our strategy in the middle of a downturn. We're not trying to switch our strategy when someone's saying, pick the stock, you can make a lot of money. We're not trying to manage our money based on fear or greed. We're trying to be consistent with the plan that we have. So the other key part to take away is we have to think about what risk we're willing to take and what risk do we need to take. So what we can look at is I can't be successful in my life if I just stash my money in a mattress. I can't be successful if I just save my money in a high yield savings account because that interest rate doesn't earn me enough money to compound and build wealth. I'm trying to find that fine balance where I know how much money I need at the end of the day. And so I'm balancing the risk I'm taking. And if you can do that, then it's a lot easier to sleep at night because it's this mindful practice of I'm assigning my dollars to my plan, and this is what I have to do to be successful consistently. And this is a final thought: is it's really hard to understand and learn this until you've went through it. But what you'll realize is that the most successful investors are not actually the most intelligent. They're the most consistent. And so if you can remain consistent, this investing thing can actually be pretty simple. You just pick an allocation that meets your long-term needs. You understand your risks and you just stay consistent and you show up. But whatever you do, do not listen to people that are encouraging you to make rash short-term gut decisions on what's happening in the news cycle. That's the recipe for disaster, and you will set yourself up for long term failure if you don't have a plan that you can stick to consistently over time.